Look, if you or your family are managing the costs of in-home care, you know just how immense that financial pressure can be. But what if a huge chunk of that expense could actually be shielded for taxes? We're going to break down a really powerful, but often overlooked, tax strategy for anyone hiring a private nurse or a home health aide. And to put this into perspective, we're not talking about small change. Families can easily spend $60,000 or even more every single year for a home health aide. I mean, that's a massive drain on savings that can really disrupt even the most careful retirement plan. And at first glance, the IRS seems to make this whole situation even tougher. And here's why. The IRS basically creates what you could call a care cliff. They draw this really sharp line in the sand between two types of care. On one side, you have deductible medical care, things like giving injections, changing wound dressings, stuff that requires a license. But on the other side, you have non-deductible custodial care. That's all the help with daily life, like bathing, dressing, or just general supervision. And for most families, the vast majority of their costs fall right into that non-deductible bucket. But what if we could flip that entire framework on its head? What if the right piece of paper could legally transform those personal, non-deductible costs into fully qualified deductible medical expenses? This is where the whole game changes. The solution is all about what we're calling the Plan of Care Shield. And what's so fascinating about this is that the deductibility isn't really about what services are being provided, it's about the administrative framework, the paperwork that surrounds those services. So with the right documentation, you can effectively reclassify the entire cost of care. Okay, so how do we actually do this? Well, there are two absolutely essential keys to unlocking this deduction. First, the person who's getting the care needs to be officially certified as chronically ill. And second, a formal plan of care has to be established by a licensed healthcare practitioner. You need both. So let's break down that first piece. What does chronically ill actually mean in the eyes of the tax code? Well, it means a licensed healthcare practitioner has certified them as meeting a specific standard within the last 12 months. This isn't just some casual diagnosis. It's a legal definition that has to be met and documented. And that certification all comes down to meeting one of two tests. The first one is pretty straightforward. It's the functional test. This is where the person is unable to perform at least 2 of the 6 activities of daily living, like eating, bathing, dressing, for 90 days or more. But it's the second one, the cognitive test, that is so often overlooked. If a person needs substantial supervision because of severe cognitive impairment, like from Alzheimer's, just to protect them from hurting themselves, they meet the standard. This is huge. It means even if they can physically dress themselves, the cost of having someone there to prevent them from wandering, for example, can become fully deductible. So once you have that certification, the next critical piece is the plan of care itself. And folks, this is absolutely non-negotiable. It has to be a formal written document. It needs to come from a physician, an RN, or a licensed clinical social worker. It has to spell out exactly how the care is linked to the chronic illness, detail the specific services needed, and say how often they'll be provided. And here's the kicker. It has to be renewed every single year for the tax year. Think of this document as your armor if the IRS ever comes knocking. All right, so you've got the certification, you've got the plan of care in hand, you've just done the hard part. Now for the payoff. You've officially unlocked 2 powerful ways to get tax relief. Let's dig into how they work. Okay, first up, you have the dependent care credit. Think of this as a little appetizer. It's a small, direct discount on your final tax bill. It's nice, but it's capped, so for most people, it's going to give you a maximum of $600 back. But the real main course, the powerhouse, is the medical expense deduction. This one is uncapped. It lets you deduct the entire cost of care as long as you can clear one little hurdle. And that hurdle is 7.5%. Here's how it works. You can only deduct the portion of your total medical expenses that goes above 7.5% of your adjusted gross income, or AGI. So if your AGI is $100,000, that means your first $7,500 of medical expenses don't count for the deduction. But when in-home care costs can easily top $60,000, you're going to blow past that threshold in no time. And that's what unlocks a massive, massive deduction. Now, claiming this deduction is a huge financial win, but wait. Before you dive in, there is a critical compliance trap you absolutely have to avoid. It's often called the Nanny Tax. See, when you hire a caregiver directly, the IRS usually views you as an employer, and that comes with a whole bunch of serious rules. So here's the bottom line. If you have the power to control not just what work gets done, but how it gets done, then that worker is your employee. It doesn't matter if you call them an independent contractor, or if they're part-time, or if you pay them in cash. For the vast majority of families who hire a private aide, that caregiver is legally a household employee. And the moment you become an employer, a whole new world of responsibilities opens up. Suddenly, you're on the hook for filing a Schedule H with your 1040 tax return. You have to withhold and pay Social Security and Medicare taxes. You might even have to pay federal unemployment tax. And of course, you have to issue them a Form W-2 every year. It's a lot to keep track of. And if you're thinking, I'll just pay cash and fly under the radar, you really need to hear this. As the source material points out, there is no statute of limitations on unfiled employment taxes. Let me say that again. No time limit. That means the IRS can come after you 5, 10, even 20 years down the road for all of those back taxes plus penalties and interest. This is serious stuff. Okay, so now that we understand the rules and that huge trap we need to avoid, let's talk strategy. How do we get the absolute most bang for our buck? Well, you can't double dip. You can't use the same expense for both the credit and the deduction, but you can strategically stack them to maximize your total tax saving. Let's run the numbers with a quick example. Let's say a daughter pays $40,000 for her mother's care and her own income is $100,000. Here's the protocol. Step 1. She takes the very first $3,000 of that cost and applies it to the dependent care credit on Form 2441. Boom! That's an instant $600 back in her pocket. Step 2. She takes the remaining $37,000 and applies it toward the big medical deduction on Schedule A. After we subtract her 7.5% income floor, which is $7,500, she gets to deduct $29,500 from her income. At her tax rate, that saves her almost another $6,500. So you add the credit and the deduction savings together, that's a total tax benefit of over $7,000. That is huge. Okay, I know that was a lot of information, so let's boil this entire strategy down into 3 simple, actionable steps you can take right now. Think of this as your personal CFO checklist. Step 1 is certify. Go get that written chronically ill certification from a physician, an RN, or licensed social worker. Step 2, plan. Have that same exact practitioner prescribe a formal, detailed plan of care. And finally, step 3, comply. Figure out if your caregiver is a household employee and get ready to file Schedule H. So at the end of the day, it really all comes down to this. We've seen how the difference between a massive tax bill and a massive tax deduction can literally be just 1 or 2 pieces of paper. So the only question left is a missing document costing your family thousands and thousands of dollars?